Assalamualaikum and a very good day. My name is Nurul, Humaira Aleeya, Binti Yusoff, and our group will be presenting our report, which is the analysis of currency fluctuations and the profit and loss assessment for forward contracts, futures contracts, and options. Our report analyzes the foreign exchange markets involving the Malaysian ringgit, which is our home currency, as the base currency, and also four other selected countries' currencies. Firstly, the Japanese yen, the Thailand baht, the Korean won, the Singapore dollar, and lastly, the Hong Kong dong. The primary goal of this assignment is to measure the Malaysian ringgit's performance compared to the Japanese yen, the Thailand bahts, the Korean wons, the Singapore dollars, and also the Hong Kong dongs. Second, the goal is to examine and also to visualize the exchange rates fluctuations or trends through graphs and charts to be able to analyze the exchange rates fluctuations. The third aim is to explore the factors influencing these fluctuations. Overall, to measure the performance of Malaysian ringgit and whether it is robust in comparison to the Japanese yen, the Thailand baht, the Korean won, the Singapore dollar, and also the Hong Kong dong. By understanding the fluctuations of these exchange rates, we can make well-calculated decisions and also actions.
Hello, my name is Ameera Najihah, and today I will provide a brief overview of the fluctuations in exchange rates for 5 currency pairs against the Malaysian Ringgit (MYR) from January 1st to June 28, 2024. The pairs we are looking at are Malaysian Ringgit per Japanese Yen, Malaysian Ringgit per South Korean Won, Malaysian Ringgit per Thai Baht, Malaysian Ringgit per Singapore Dollar, and Malaysian Ringgit over Hong Kong Dollar. Across all these pairs, we see significant volatility with changes ranging from negative 2.0% to positive 2.5%. This suggests a period of market instability likely influenced by external factors like global disturbances or geopolitical events. The MYR over HKD pair, shown by the purple line, stands out for its stability. This is likely due to Hong Kong's currency pegged to the USD and its strong trade relations with Malaysia, leading to a smaller fluctuation compared to the other pairs. In contrast, Malaysian ringgit over Japanese yen and Malaysian ringgit over South Korean won show much more volatility. Malaysian ringgit over Japanese yen, represented by the blue line, experiences swings as large as negative 1.5% and positive 2.0%. This could be linked to Japan's monetary policies or shifts in the export sector. Similarly, Malaysian ringgit over South Korean won, shown in orange line, mirrors these sharp movements influenced by South Korea's reliance on global trade and the semiconductor industry. The Malaysian ringgit over Thai baht in green line displays moderate volatility with occasional spikes. Thailand's post-COVID recovery in tourism and strong agricultural exports may be driving this trend, particularly during the Songkran festival in mid-April. After that, the Malaysian ringgit over Singapore dollar, shown by the light blue line, remains relatively stable, reflecting Singapore's strong economy. The slight fluctuations seen in February and May may be tied to regional developments like Malaysia-Singapore trade relations. Therefore, we have observed that the synchronized movements in these pairs during periods like late February, mid-May, and late June are likely reflected by global events such as oil price changes or decisions by the US Federal Reserve. For traders, Malaysian ringgit over Japanese yen and Malaysian ringgit over South Korean won offer short-term profit potential but with higher risk. On the other hand, Malaysian ringgit over Hong Kong dollar and Malaysian ringgit over Singapore dollar are more suited for conservative investors due to their stability. In conclusion, it is important for policymakers, businesses, and investors to understand these trends in navigating the volatile forex landscape.
Assalamualaikum. My name is Syahrina Binti Mohd Amran and my ID number is 242024741147, and I would like to present about the selection for the best currency against Malaysia ringgit. In this assignment, we choose 5 countries and the selection are based on the interest rate changes and the economic indicators. Firstly, for the MYR versus Japanese yen, with the average changes in exchange rate is negative 0.0759%, indicates the operation on the MYR or Malaysia ringgit compared to the Japanese yen on the 1st May of 2024. And for the second factors, which the economic indicators show the economic growth in Malaysia but decline in the export activities that lead to decline in the Malaysia ringgit. And is MYR versus Korean won with the average exchange rate of negative 0.0283%. The interest rate influenced by the domestic policy that give impact on the price and also for the subsidy program in the country. In economic indicators show the increase in the employment rate lead to the high consumption spending for the local spending. For the third country, which is MYR versus Thailand baht, which the average exchange of rates also show the negative figure that influenced by the export activity that slowly decline, and Bank Negara Malaysia maintain the overnight policy rate or OPR at 3% to contract the inflation from happening. As the economic indicators, which also decline in agriculture and also electronic due to the bad weather, and also decrease in the demand and supply. The fourth country is Singapore with average exchange rate of 0.0002% that influence on the BNM, Bank Negara Malaysia OPR support the price stability and also price level and boost the gross domestic product in Malaysia economy. For the economic indicators, it showed the increase in foreign direct investment coupled with the domestic consumption strength. Lastly, which is the best currency, and the currency that we selected is Hong Kong dollar against Malaysia ringgit. For the factors of interest rate changes, to maintain the inflation rate in Malaysia, Bank Negara Malaysia keeps the OPR at 3%, and for the economy indicators, Bank Negara Malaysia or Malaysia economy boosts the digital industry by funding them from the finance.
Let's move on to the next part, which is identifying the lowest exchange rate peaks of Malaysian ringgit against the Singapore dollar and Malaysian ringgit against the Hong Kong dong in the months of April and June. Firstly, the lowest exchange rate peaks for the Malaysian ringgit against the selected foreign currency, the Singapore dollar, in the month of April is on the date 1st April 2024. The lowest exchange rate recorded on the date was quoted at RM 3.4934 per RM 3.5088 per Singapore dollar. Subsequently, in the month of June 2024, the lowest exchange rate was quoted at RM 3.4661 per RM 3.4792 per Singapore dollar, which is observed on the 26th of June 2024. Let's move on to the Hong Kong dong. The lowest exchange rate peaks for the Malaysian ringgit against the selected foreign currency, the Hong Kong dong, in the month of April is recorded also on the 1st April 2024. The quoted exchange rate was RM 60.3519 per 60.4462 per 100 Hong Kong dong. For the month of June, on the other hand, the lowest exchange rate peak is observed to be on the 4th and also on the 7th of June 2024. The set exchange rate quotes are RM 59.8684 per 60.1595 per 100 Hong Kong dong. There are several factors that may have caused the Malaysian ringgit, the Singapore dollar, and the Hong Kong dong's exchange rates to fluctuate to its lowest peaks in the months of April and June 2024. The first factor that must be highlighted is interest rates. A higher interest rate in Singapore and Hong Kong compared to in Malaysia will attract capital inflows, strengthening their currencies and weakening the Malaysian ringgit. Second, weak economic performance from Malaysia that can be portrayed by a slow gross domestic product (GDP) or a stronger than expected reports of GDP from Singapore or Hong Kong may have contributed to the Malaysian ringgit's depreciation. Lastly, trade deficits in Malaysia, especially during the observed periods, can exert downward pressure on the Malaysian ringgit, especially while trading activities in Singapore and Hong Kong dong supports their currencies. Next is the cross rate calculations of Singapore dollar against Hong Kong dong and Hong Kong dong against Singapore dollar. The formula used is as above on the right hand side. For the first part, the Singapore dollar will be considered as the home currency and the Hong Kong dong will be considered as the foreign currency. The obtained bid price for the month April was 17.2002 Singapore dollar per Hong Kong dong, and the obtained ask price for April was 17.3030 Singapore dollar per Hong Kong dong. For the month of June, the bid price was 17.2075 Singapore dollar per Hong Kong dong, and the ask price was 17.3565 Singapore dollar per Hong Kong dong. The second part, the Hong Kong dong will be considered as the home currency and the Singapore dollar will be considered as the foreign currency. Firstly, in the month of April, the bid price was 0.0578 Hong Kong dong per Singapore dollar, and the ask price was 0.0581 Hong Kong dong per Singapore dollar. In the month of June, on the other hand, the bid price was 0.0576 Hong Kong dong per Singapore dollar, and the ask price was 0.0581 Hong Kong dong per Singapore dollar. To further analyze the cross rates, there are two questions to be answered. First, how does the cross rate reflect the economic conditions of the selected currencies countries, which are Singapore and Hong Kong, compared to Malaysia? A strengthening currency like Singapore dollar against the Hong Kong dong stipulates stronger economic growth or investor confidence in Singapore compared to in Hong Kong. The factors influencing currency include trade balances, interest rates, and economic growth. Exchange rates are significantly affected by economic fundamentals, including the trade dynamics and the monetary policies. The second question is, what role do geopolitical events play in influencing cross rates? Geopolitical events can significantly impact cross rates by compromising investor sentiment and confidence, and also economic stability. Trade disputes, political instability, or changes in international relations can lead to currency volatility. There is an increased exchange rate volatility as investors react to uncertainties by adjusting their currency holdings. Political instability in Malaysia, Singapore, or Hong Kong can lead to shifts in capital inflows or outflows, causing fluctuations in the Malaysian ringgit, the Singapore dollar, and the Hong Kong dong.
Assalamualaikum. My name is Qistina Binti Ifnu Hakim and my ID number is 2024 767 377. There will be a calculation for Singapore dollar and Hong Kong dollar forward rate calculation. So for forward rate calculation, firstly we need to find a forward point. To find forward point, we must have interest rates because the formula is spot rates times interest rate home country minus interest rate foreign country times the times for 1 month will be 1 over 12 and 3 months will be 3 over 12. So for Singapore, the interest rate per annum is 3.30%. For Hong Kong, it's 4.75%, and for Malaysia, it's 3%. So After we find forward points, then we will find the forward rate. Forward rates will be spot rates. If it's a discount, which is negative, will minus. If it's a premium, it will be a positive in the forward point. So for Singapore dollar, both 1 month and 3 months is a discount, and the final answer is for B. Singapore is 3.402 for bit, and for us it is RM 3.4814. For 3 months, the bit price is RM 3.4785, and for us it is 3.4797. Next, for Hong Kong dollar, the percentage is 4.75, and both 1 month and 3 months is a discount, and the final answer for 1 month B is RM 58 ringgit 0.7505 cents, and for us it is RM 58.7714. For 3 months, the bid is RM 58 ringgit 58.5789, and for us it is 58.6243. So in forward calculation, the first question is, what assumption that did we make in calculating the forward rates, and how do this assumption impact our results? So the first assumption is the interest rates per annum of the countries. The interest rate will keep changing based on central bank, and we make the assumption based on the economic conditions. How will this impact our result is, if the home country's interest rate is lower than the foreign currency, then it will be expected that the currency of home country will be a discount and will be less than the spot rate. And another assumption is that there is no arbitrage opportunities, and the only factor influencing the price difference between spot and future contracts is interest rates. The second question is, how does the difference between spot rate and forward rate indicate market expectation? So spot rate is the price today, and forward rate is the price in future, the expected price in the future. So if the expected price, the expected rate is negative, which is discounts, and the rate will be less than spot rate, which means that we will expect that the market will not be good because the currency is lower than today, and is a premium. We will expect that the market in the future is better than today.
For futures calculation, the closing price on Monday, 13th May 2024 is RM3.4973 per SGD. On Friday, the closing price is RM3.4835 per SGD. The decline of the Singapore dollar relative to the Malaysian ringgit during this time frame can be linked to a slight increase in inflation in Malaysia in May. If investors choose to take short position in trading of SGD, they will take a delivery of 17,200 ringgit loss, whereby if investors choose to take long position in trading of SGD, they will take a delivery of 28,950 ringgit profit.
So based on the calculations, to make profit, the investors should choose the long positions. And this is mainly because the Singapore's economy is growing slowly, mainly to the decline in manufacturing sector. Furthermore, in order to manage the risk of international commerce, Malaysia has also been strengthening its economic links with Singapore, which this partnership is expected to boost Malaysia's economy by 2030 by creating employment opportunities and attracting international companies. Singapore's manufacturing sector, along with strong service sector growth, might support the Singapore dollar. And other than that, Malaysia's initiative to strengthen economic integration with Singapore could affect Malaysian ringgit, possibly leading to favorable exchange rate movement for Singapore dollar. However, investors should stay alert to global economic developments and monetary policy decisions that might influence currency valuations.
Next, I will present about the option market. For the introductions for the option market is option contract is divided by two, which are a call option and also put option. For this option market, it allows the buyer to buy or sell an underlying asset at the determined price within a specific time frame given. A call option gives the holder the right to buy a stock, and a put option gives the holder the right time to sell the stock.
My name is Illia Assifa Binti Amir and my ID number is 20247671. I will continue the team discussion on the option for the recommendation part. For the recommendation part, put option be selected. This is because when the call option will give the right for the holder to buy a stock, but the put option will give the right to the holder to sell the stock at the higher strike price than the market price. Moreover, interest rate in Malaysia will decline the attractiveness of the investor to invest in Malaysia ringgit. So it will lead to the increasing in the FDI, foreign direct investment for the Singapore. Not only that, put option also will allow to create the opportunity for gain while benefiting from the downward movement in exchange rate. Put option also will help in the risk by protecting from losses if the price drop. It allows the asset to be sold at the set price. If the market price falling, it will reducing potential losses. Next, we go through for the exercise price calculation. For the bid 28.69000, for the premium MYR 0.05, for the profit MYR 1.90, for the put option MYR 30.6400. To summarize, the 2024 Malaysia Ringgit MYR rate of exchange with the Singapore dollar, SGD and also Hong Kong dollar, HKD are influenced by the key factors such as the monetary policy, interest rate change and also general economic health. Because of their stability, the MYR/HGD and also MYR/HKD pairing are highly recommended, although MYR/KRW, Korean won, lag because of its weaker economic performance. Additionally, investors can effectively control risk by using the put option strategically, particularly in a situation where there may be a decrease in MYR. In addition to protecting against losses, this strategy offers a chance to profit from the market change, making it a successful strategy in a current currency market. That's all from us. Thank you.